Hello, and welcome to the Cornerstone Asset Management Services Quarterly Spotlight. My name is Christine Buell, and I am an investment advisor at Cornerstone Asset Management Services, and I'm your host for today's Quarterly Spotlight. We are recording this spotlight for playback capabilities. The title of the spotlight is Utilizing Tactical Management to Reduce Risk. I want to tell you a little bit about myself. I've been a part of the sales team at Cornerstone since it began in 2005. So I like to say that I'm an original, and I got started with Cornerstone when somebody said to me, you got to hear this story and what it can do for clients. So I'm actually happy to have this opportunity today to share with you the same story that got me started. I want to tell you a little bit about the flow of this session. We anticipate a 30-minute total time frame. That does include this little bit of an introduction and then the gist of today's topic. And then at the end, we are going to open the floor for questions. Just want you to know that all callers are muted and you're going to remain muted. So if you do have questions, please use the chat box. Our aim for today is to discuss our philosophy with you. We are looking to strategically partner with advisors who value quality money manager relationships and who see the need for a disciplined approach for investing. I promise you that you're going to hear a perspective worthy of your consideration for each and every one of your clients. What is before you today is an opportunity for you to add strategies that diversify, better balance, and lessen portfolio risk, whether it is the total client portfolio or it's adding value by rounding already existing strategies. We offer a spectrum of strategies from the overall to what you might call a niche. Cornerstone Asset Management Services is a boutique third-party money manager and a registered investment advisor. We are located in Cleveland, Ohio. We serve individuals, institutions, retirement plan sponsors, and their participants across the U.S., and we use a number of different platforms. We focus on one thing: creating and managing wealth through thoughtful and prudent management of the individual portfolio assets. Our value added lies in actively managing the downside risk, and it has the effect of reducing drawdown during market declines. Our process is proprietary, and it is by no means cookie cutter. We offer daily valuations, active management, and professionally managed account solutions. As advisors, we all know that what our client keeps matters more than what our client earns. And as advisors, we want nothing more for our clients than an increasing bottom line. At Cornerstone Asset Management Services, we find that our processes can significantly reduce the drawdown experience during market declines. Further, the investment process produces low volatility portfolios. Typically, betas are in the 0.3 to 0.6 range. At this time, I'm going to be handing the presentation over to one of our principals and a portfolio manager, Nick Anastasakis.
Thank you, Chris. Good afternoon, everybody, and thank you for joining us. Like Chris said, we are a registered investment advisor in Cleveland, Ohio. We operate as a third-party money manager. We started Cornerstone in 2005 and started managing actual client accounts in January of 2006. All of our key strategies have actual history. Since 2008, we don't produce or show any hypothetical results. Everything is actual history. We are very much a research-focused shop. Extensive research done on a daily basis, analysis and strategy backtesting, daily monitoring of both accounts and market activities and models. We actively monitor and manage 140 computer models that are fully backtested on a daily basis. Contains literally thousands of ticker symbols that are monitored for trends. Our focus is on tactical strategies. That's kind of our core, our bread and butter, if you will. All asset classes sort of go anywhere funds. Those tactical strategies can be 100% cash, 100% bonds, 100% equities, and literally anywhere in between at any given time. Our platform scope was expanded over the years to include passive strategies as well as tactical strategies, individual stocks for our dividend portfolios, tactical fixed income, mutual funds, Variable annuities have always been a part of the practice, as well as 401ks, whether that's plans or individual participant level things, in addition to all of the focus on the tactical strategies. What we do, and Chris sort of touched on it briefly in the intro there, Cornerstone provides a platform for RIAs and independent financial advisors to have access to a wide variety of investment options to satisfy their client investment needs in order to grow assets through prudent management, allowing you, the advisor, to really focus on client relationship building, client financial planning, and client management, if you will, allowing us to, so we sort of focus on all of the investment management framework. You'll see on all of our materials on the web and everything else the words systematic, unemotional, and disciplined. We truly believe in having a system, using a system. It makes the investment process repeatable, in our opinion. We follow an unemotional, rules-based decision-making framework, and you follow the rules. That's what creates the discipline. So you establish the rule, and then you follow it. A little bit of background, I guess, on me. My degree is in finance, but that's not really where I started. I actually started in architecture, building things. Maybe even for me, a little bit more of the curiosity on taking things apart, curiosity on how things are constructed or organized. I have a very scientific focused mind. I often kind of refer back to the scientific process where you sort of establish a hypothesis, test it, back test it, and then come to a conclusion. For me, the devil's always in the details. And now I literally construct portfolios from the bottoms up, hence our sort of building theme, right? Cornerstone, capstone, the foundation, etc. When we refer to the CAMS or the Cornerstone tactical process, what we're talking about is a quantitative relative strength-based or RS-based filtering system. At the core of what we do is an RS-based system where we are attempting to or focused on identifying trends in the markets, telling us the what is working right now. That RS filter gives us the what we should be looking at right now from the universe of literally thousands of mutual funds, ETFs, stocks, indexes that the system tracks. So that's giving us the what. The hybrid part of the analysis comes from the fundamental and technical side of things. The fundamental, if you want to think of it as answering the why. Why is that fund coming up right now from an RS perspective? Why is that fund doing what it's doing? And then the technical kind of gives us the answers, the when, timing signals, timing on buys and sells. I'm very much a chartist. I look at a lot of charts, monitoring, support and resistance level, moving averages, oscillator positioning, trend changes, because that's really what we're trying to identify is trends that we can act upon. What our process really results in is a low correlation, low beta, low standard deviation portfolio construct. Chris kind of touched on the betas during the intro. Our typical portfolios have anywhere from about a 0.3 to a 0.6 beta. If you think comparatively to the S&P 500 with a beta of 1.0, we're roughly taking on a third or maybe half the risk of the S&P over the long term. Correlations on our portfolio are roughly in the 60 to 70% range, and standard deviations are in that same relative range as well. So in this topic of using tactical management to reduce risk, I think it's always helpful to sort of define what is risk. What is risk to you, or what is risk to your clients? To me, how I answer that question, risk in investing is your money isn't there when you need it to be. Very simply, I think any financial advisor who's been around for a while now has had a client who intends to retire. Think back to the years 2008, 2009. You had a client who intended to retire during that time frame, and their 401k is now a 201k after being maybe overly allocated into equities. And now they have to make the decision, or along with your guidance, I guess, and planning capabilities, make the decision on whether they can afford to retire and live off the money that they have, their 201k, or if they have to work for 5, 10 more years, who knows, because they can't afford to retire. That, to me, is risk. Their money isn't there when they need it to be. And that's what really takes us into the main topic for today, why utilizing tactical management to reduce risk matters. We're going to really base this call off of a white paper that I wrote back in 2014, What Does Managing Risk Look Like? I'm sure most of you have probably seen it. It's available on our website for download to refer to. We put it in a lot of our marketing materials and things like that. But what we did when when I wrote this back in 2014, we were looking at the monthly returns for one of our flagship portfolios, the Cornerstone portfolio, and comparing it to monthly returns of the S&P 500. And we're looking at highs and lows and correlations and patterns. And what we really came to focus on was the highs and lows exhibited by the S&P 500 during that period. And the period that we were analyzing during that first white paper was from strategy inception, which was July 1, 2008, through the end of 2013. And the results, while not surprising in and of themselves, really confirmed our premise that by using an active management approach or a tactical approach, we can greatly reduce or lessen the impact of large losses on a portfolio's value caused by stock market volatility. You'll see here in the chart, I pulled out the top six. So I kind of focused on the top six, the bottom six. I called them the best and the worst, right? The worst are here, your 6 worst months in that time frame from 2008 to 2013, ranging from about a 7% down month to almost 17% down month in October of 2008. And then you'll see the applicable or the Cornerstone portfolio's performance in those months as well. So the premise works, right? We got out of the way. We were able to identify when to get out of the way of a severe down drop in the market and be positioned so that the portfolio doesn't take on that draw. So a strategy that looks to minimize risk, such as Cornerstones do, should lessen an investor's exposure to those declining markets, blunting the impact of those bear markets and preserving capital, the majority of that capital ready to go back in, and preserving the majority of those prior gains. Now, moving out of the market prior to a decline means that you have more money to invest when the market does head back up. Now, the flip side to that, obviously, is when you have a strategy that's focused on reducing risk or reducing drawdowns on the downside, focusing on that downside protection, it can mean potentially that we don't capture all of the upside gains in the market, and that was very true. So here are the 6 best months in the S&P 500, same time period, 2008 through 2013. Best month being about almost 11% gain in October of 11. Ranging, from 6.5 to almost 11%. So we don't get, your beta. If you're taking on 30% of the risk, you shouldn't have, the expectation to perform 100% on that upside, and that's exactly what the research shows, basically. But bringing it all together kind of transitions to the second of the white papers that I wrote in that same time frame. How long does it take to recover? And what we really kind of came to realize is the reality of down markets. Yes, investors lose money, but more importantly, they lose valuable time and opportunity to be an investor. Real damage isn't done by the market. Real damage is done by human behavior. Human behavior dictates that typically investors hold on too long until the pain of their loss becomes too great, and then they sell out, typically at or near that bottom, missing any chance of a rebound. And then what's even worse is they're discouraged to reinvest until the markets are making new highs, thus missing that opportunity to recoup their losses. It harkens back to the old Warren Buffett, be fearful when everybody else is greedy and be greedy when everybody else is fearful. The typical investor makes the wrong decision, and that's human behavior. So for us, it's really not about what you earn, it's about what you keep. And if you can miss those big drawdowns, you're going to be that much further ahead when the recovery happens. And that's what that second white paper sort of focused on. How long does it take to recover? The orange line there is our Cornerstone portfolio, blue line being the S&P. You can see that by not incurring the big drawdowns of 2008, 2009, the time to recovery was about 50% less, 29 months versus 59 months for the Cornerstone portfolio versus the S&P 500 back during that time frame. Don't give it up in the first place, I guess, is the moral of the story. And we can all kind of picture, we all know that graphic of the arithmetic of loss, right? It takes 100% gain to recoup a 50% loss. So if you can minimize those losses, you're that much ahead of the curve on the way back up. That's truly the premise of risk-based tactical investing. So bringing it forward, I guess, a little bit, in preparation for this webinar today, what I wanted to do was sort of take this approach, run it forward to present day. So what does it look like today? So we again went back, we reviewed that monthly return data for the S&P and the CAMS Cornerstone portfolio, again, up to present day. It's now almost 140 monthly periods. We've got an additional 43 months since that initial review. So what did we find? What did we find when we went and did that? And this is where I was a bit surprised. So we are in this raging bull market higher. We found 0 additional worst months and 1 additional best month. It's just kind of unbelievable, really, when you sit back a little bit in your chair, because what does that tell us? It tells us that there's been very little volatility during that last 3.5 years of this, again, raging bull market. Everything just keeps going higher and higher, but there's no volatility. There's no additional worst months. There's no additional best months. It's just somewhere in the middle, right? It's not a volatile ride. Whether that's good or bad, we don't know, but it's not volatile. So we come to a couple of different conclusions after that. So, research tells us that the typical bull market lasts 57 months. We're going to round up and we'll call it 5 years. The current bull market that we're in is in year 8, maybe 8.5, because March 2018 is going to be 9 years. And what we know is we haven't had a correction of 10 or more percent since late 2015. So we're again approaching 2 years since just a 10% correction. So we feel that we're very overdue for 2 things, right? We are overdue for some volatility, and we're overdue for some downside move or correction, or maybe worse. And what really kind of comes what hits home now is when I'm prepping for this call, I'm having this conversation with our Director of Market Research, Ken Reinhardt, and he said, well, don't forget where the markets are valuation-wise. And he said, add a couple of charts that speaks to valuation. So not to mention, we're overdue for volatility, and we're overdue for some kind of a downside or a correction. We're also extremely overvalued. The chart that I'm sharing here is a chart of the S&P 500. That's the black line. You can see a red line, a blue line, and a green line right below it. What those are representations of PEs, market PEs. The red line is what we're going to really focus on. That's given a PE of 20, and that's called overvalued in the market. And you'll see that where we're at current day, I'll highlight it with the pen real quickly here. Over on this right block is where that's kind of broken out for current day. The black line is substantially above the red line. We are way above historical overvalued, considered high numbers. The only other time that it's been above that red line for any length of time is back to that 99-2000 tech boom back in this range right there. So you can see the market's extremely overvalued. We're overdue for some volatility, and we're overdue for a correction. The next one I wanted to share is another sort of visual aid that I think helps. This chart comes to us from thechartstore.com. What this shows us is the average number of hours of work needed to buy the S&P 500. So really what this is kind of showing us, to me, it says what does the real person need to buy stocks at these levels? And you'll see, you see on the chart, we've only been at these levels once before, and that's, again, in that 99-2000 level time frame. What this is telling us now is you need 108 hours of work if you're making $22 an hour to buy the S&P 500. So again, another visual that we like to share, illustrating the fact of how overvalued we are, what it takes for the average person to buy the S&P 500. I'm not going to dwell on it here. That's really Ken Reinhardt's realm. He's going to spend some time there in the fall. Wink, wink, watch for the November call. He'll be focused on some of that market overvalued and some of the economics of things. So I'm not going to dwell there. I'm just trying to stress that we're overdue for some volatility, we're overdue for some kind of a correction, and, oh, by the way, we're extremely overvalued. So to bring everything kind of together, what we feel now is the time. If you're not using some kind of a risk-based tactical strategy in your client portfolio somewhere, in some fashion, please consider doing so. And you really should consider doing so right now because of the environment that we're in. Again, we feel that we're overdue for volatility, we're overdue for some kind of a correction, or possibly worse, and we're extremely overvalued in the markets. That doesn't line up to a real good mix. So if you're going to do it, you really should add something like that. Consider a piece of low correlated, low beta type tactical strategy inside your client portfolio. At this time, I'm going to hand it back to Chris. She had some additional sort of sales ideas that she wanted to share. So Chris, if you want to go ahead.
Okay, thanks, Nick. As I'm listening to Nick, I'm kind of thinking back over, how it is that you might be thinking of making this presentation, or at least introducing concepts of, low volatility portfolios to your client mix. And I think it's important to consider that it's said that the only sure thing is change itself. And if you think over any client that you've had for a while, or regardless of how long you've had them, one client is going to have differing financial needs over their individual life expectancy. And I actually think that people expect change. So I think it's quite easy and it's quite natural to think that when you're using or considering adding this, I like to start out with it's time to be considering adding, whatever it is that I'm trying to make the presentation on, or I like to start with I can now show you. I really think that people like change in general. They, as I say, come to expect it, and it is far more powerful to add. So I present it from the idea of clients do see the value of adding risk management. They like the concept of being able to pull back into cash in uncertain markets. That is actually in itself really powerful, and it really hones in on the fact that you're just not in for the full ride on the downside of a market downturn. Among the other things they like is the value of adding asset classes, or they like the idea that they're only going to be invested in an asset class when it's time to be invested in that asset class. That, in other words, they really like the idea of active management. So I think that presenting it on the more powerful adding to what they already have, their already existing strategies can work. And then the other idea that I have is, and I find this part kind of amusing because in all the years that before I started working with active management, when I was doing mutual funds or whatever the product was that I was showing people or working with people on, no one ever called me and said, that mutual fund that I have is 50% in cash or whatever it is. But on occasion, people will call and, talk with me about the fact that their portfolio, their Cornerstone portfolio, is now half in cash or, whatever the percentage is. And I always view that as a really positive thing. First of all, I'm very, very happy that they're paying attention. I love that idea. I love the fact that they consider this to be a team effort. And the other thing that I would say is when we are in cash as an active choice, and it's helpful to keep that in mind and to say that back to them, is that the fact that we're in cash is that we are actively choosing to be in cash. So those would be the couple of sales tips that I would have, and I'm going to hand it back to Nick.
Sure, thanks, Chris. Just to kind of finish up here, well, maybe we'll open up for questions at this time. Stephanie, do we have any questions?
Yeah, we did have a couple questions come in. First one here. What is the typical time lag from money coming over to being fully invested, and where is it held until it is fully invested?
Good question. Thank you. So first off, maybe address our custodian. Custodial, we use TD Ameritrade Institutional. So the accounts are held with TD Ameritrade at the individual level. It's not a pooled investment or anything like that. And typical, when a cash hits an account, we typically are pretty slow to invest it. We're not going to just lump it into whatever the model holdings are. It typically can be somewhat of a process. That process might take several months. It might take 6 months, all depending on specific strategies and market environment, quite frankly. So, if we're very heavy on, like Chris said, the active allocation into cash, it might be even longer for a client's account to be fully invested. Until it's fully invested, it would sit in the custodial cash portion or the money market fund in the account, like I said, at TD Ameritrade.
Another question we received, how do we bill on 401k accounts?
Good question. Billing on 401ks can be done multiple different ways, actually. And really 401k management as a whole is sort of a whole different ballgame. But we have been and can be an investment choice for participants from the custodial level. So we can put our tactical models in as an investment choice in 401ks. For sure, can ask us more about that. Or we can actually do like participant level 401k management. So say you have a client that works for a key bank or university hospitals or something like that. They can give us access to their 401k to make the investment choices for them, to monitor it for them on a daily basis. And in a scenario like that, where we're not the custodian on the funds, we typically issue an invoice, whether that's a quarterly invoice based on assets under management or a quarterly kind of consulting agreement as an as-needed sort of a thing. Clients can pay via check or have used even PayPal to use, like a credit card or debit card or anything like that to pay those fees.
Okay, another question we got to come in. How quickly can you typically react to a downturn in the market?
Good question. Typically, we can move pretty quickly. I don't think it's ever happened, but, could sell out completely in a day. Like I said, I don't think it's ever happened. Everything that we buy is monitored via stop losses. So we don't ever want to let anything go too far. We've got our finger on pretty much everything. Every position that we hold is monitored on a daily basis, like we talked about. We have gone 100% cash in portfolios. It happens. It's not usually over the course of a day. It's usually more of a sort of a drawn-out thing where we're monitoring sort of deterioration position by position. And sort of walking things out of being held. And so it's typically more of a process where you'll see it a gradual move, where we build cash, so to speak. So it's not typically in a day sort of a flash out, flash in sort of a thing, more of a process typically, but it could be done in a day if we really needed to. If market environment was such that we needed to, we certainly could sell everything in a day.
Another participant question, are we able to use any inverse funds?
Yeah, good question. We can and do use some inverse funds. Obviously, it would be based on client risk objectives and portfolio objectives. So inverse funds would probably be limited to more of our the higher risk portfolios, like a capstone portfolio. We don't short any specific securities. We would buy an inverse fund if we wanted to short a specific area. So we could do that in capstone. We could do that for sure in Ken Reinhardt's Spectrum portfolio. I'm sure in November he'll speak more about that. But yes, we do have the ability to use inverse funds if we need to.
Okay. Another participant question, is there a minimum dollar volume for accounts?
Okay. Minimum dollars kind of depend on the platform that we're using. So sort of an entry-level platform that we have is our ETF. This is more of a strategic platform where you can pick and choose a couple of ETFs. We have a minimum set on that for $10,000. The tactical strategies that we talked about for most of this call at a specific individual strategy level typically have $25,000 to $30,000 minimums, and then sort of our top of the line platform is our alpha beta platform, where you can blend multiple strategies inside a single account. That has a $100,000 minimum account value.
Okay, and one more question I have here. As an RIA in Ohio, how can I be licensed with Cornerstone?
So a couple different ways that we do this. Obviously, everything can kind of be customized per the relationship that we're intending. If you have your own RIA, you own your own firm, what we typically like to do is form a sub-advisory relationship where you would be handing off some or all or most of the investment process over to Cornerstone. We typically prefer to do all of our trading and billing on anything that we manage here in-house, so that, again, I'm very much a devil's in the details kind of a guy, so I do all of our trading. So typically it would be under a sub-advisory agreement. We do work with a number of independent broker-dealers, and so if you're an IAR of one of those broker-dealers, we certainly can have that sort of arrangement as well. So again, we're pretty flexible and can customize the relationship as we kind of need to, basically.
Looks like that's all the questions I have here on my end.
Okay. I guess just maybe real quickly, up next, what we'll show, keep a lookout for the next installment of the CAMS webinar series. We're going to have our Director of Market Research, Ken Reinhardt, will be on in November, Wednesday, November the 8th. I'm sure you'll start to see some invitations for those float around. Ken's going to be really focused on market fundamentals and valuations and all of that kind of stuff, in addition to speaking specifically on his portfolio, the Spectrum portfolio, with us. And that's really all we got for you guys today. Thank you again for attending. I'll leave you with follow us on social. If you're not already, we are on Twitter, Facebook, LinkedIn. You can find those links from our website, from all of our emails and stuff like that. So if you're on social places, it's a good place to keep in touch with us, get timely updates and things like that. And at this time, thank you very much for attending, and we look forward to having you on the next call in November. Thank you.